Welcome again to our course on biodesign, strategies for innovation and design of bioengineering. Today we're going to take a look at operating plan and financial model topics. So let's start. So for today, we have three objectives. First, to understand the process for developing an operating plan and some cost projections. Also, I want you to create a revenue model and integrate it with the cost projections into a financial model to support your business planning. And finally, I want you to be able to recognize the general attributes of medical technology financial models. And this we want to achieve in a broad sense so that you are capable of actually investigate later on how these models are actually constructed and for you to practice later on those. But to understand financial models and projections, we have to think again on the basics, and that basic is the difference and the relationship between cost and revenue, which is something that is going to be deeply involved in everything that we do at a company. In this sense, facilities, capital equipment, salaries, and cost of goods and services depend specifically on the personnel and sales that you want to have. All that adds up to costs, and costs relate negatively to revenues to generate margin. In this sense, margin is the subtraction between revenues and cost, which is something of utmost importance to recognize and how this flow goes in order to perform and to create your financial models. It only suffices also to say that revenues is the multiplication between sales and prices, and that's going to be important for you because it's also an input of those models. But how do you go and actually try to sketch out a financial model? Well, there are several algorithms on things to do throughout the course of the sketch of these models and all the components that it has. In these terms, the graph that I'm showing here to you starts with an operating plan, is what you want to achieve and in what time. How many types and what types of employees do you need to achieve for this operating plan to succeed, and when should you hire them? That's the definition of a staffing plan, which is a second step in performing a financial model. After doing the operating plan, you should also question yourself, when will the product be ready to begin sales, and when will my company want to enter the target market? As always, the market defines always the dynamics of the company and the strategic focus that it should have in terms of time, funding, and operations. That two questions define what we know as market model. Having the staffing plan and the market model is an input for the cost projections, because depending on the amount of employees and operations that you want to have, and also the market dynamics that you're going to have, then that's going to define your costs. Three big questions have to be asked in terms of staffing and market in order to create the cost projections. First, what are the staffing costs, right? Is very specialized personnel the one that you need? R&D people tend to be really costly. Also, managerial teams that are really effective are costly. If you only need to scale something to manufacturing, or if you only want to produce something, then maybe cost of employees may not be as high as the ones mentioned before. The other two questions to ask yourself in terms of cost projections are how many units are going to be sold or need to be sold in order to succeed in the market that we are targeting. And also, what are the costs of goods and services that you need to produce, that you need to use to produce your product. With all those costs, staffing, units sold, and cost of goods and services, you can have your cost of projections. With that input, you can do two things. First, to adjust for different things, just as depreciation or taxes or any other circumstance that may be of relevance in your nation. And secondly, to costs. With those two variables, you can first create what is called a cash flow statement, which is one of the final endpoints of a financial model. And finally, by doing cost projections and actually assessing the costs and the sales of whatever you're doing, you can create what is called an income statement. And with a cash flow statement and an income statement, and relating those two with pre-tax income, then you can have a sound financial model. So how does these different components of a financial model actually look like? It only suffices to look at the ones that I'm going to show you now. Even though we're not going to explore them thoroughly, it's important to actually know how they might look like. First, as we started with an operating plan, it's basically a Gantt diagram or some sort of layout that states what your biggest milestones are and when those may happen or need to happen in order to succeed in the business that you are trying to develop. The staffing plan that derives from the operating plan, it basically lays out the amount of personnel that you're going to need throughout the entire cycle of the business and how those employees are needed to be hired or fired throughout time. That you relate eventually with the costs of each employee, and that's going to add up to your cost planning and cost projections. Though before that, you have to create what it's called a market model. And market model is important to assess at the very beginning of this process also, because it will define if it's even worth pursuing this business since the very beginning. In terms of market model fitting schemes and models, we have two main approaches, the bottom-up approach and the top-down approach. The bottom-up approach, as its name may suggest, it goes from down to top. And by down, it means more specific, more reachable and maybe accessible information about the specifics of one company or several companies. In these terms, a bottom-up approach starts with how the costs and the expected sales or sales that the company has already had in order to build up to addressability of a big market. In that sense, fundamentally understanding of the market is going to be needed in order to perform this. But it only suffice to say also that a bottom-up approach is going to be more exact probably, but more difficult to perform, just because it requires data that might not be easily accessible or reachable for you. A top-down approach, it's basically taking the big picture and trying to assess the small pixel. First, it starts with an understanding of the macroeconomy and business data and market research reports, and with that try to lay out a model that makes sense in order to actually perform a financial model and to validate the business. With these market fitting schemes, you can create the market model implementation as I'm showing here. In this sense, you run through time all your assumptions and try to think about how much the market is going to be giving to your company in terms of sales and in terms of the product that you can introduce into that market. One of the most important things to realize in market model implementation is the idea of assumptions. The key assumptions must be easily readable in any market model implementation, and it's important for you to actually put the citations and the sources of any of your assumptions, because that's going to give validity of your model and also is going to avoid many questions that are unnecessary for you to be asking. After that, we mentioned that we need an income statement, and an income statement is one of these outputs, big outputs in a financial model. And as you can see here, it basically has, it compares through time the revenue and the operating expenses, as well as the pre-income taxes and profit. With this, you have a very thorough implementation of what your income is going to be, and that's going to be important for you to recognize your profits. Finally, as we mentioned, the other big final output of a financial model is a cash flow statement. And a cash flow statement, it basically lays out everything that has to be related with cash needs and also with some expenses in terms of capital equipment and the things that you need to have in your company for it to work effectively through time. Also, cash flow statement is gonna specify the amount of funding that you're gonna need, and if that sources come into play, that might be also something that you can fill into this cash flow statement. Now that we have revised these formats and all these components of a financial model, it could be interesting to actually explore what could be the basic steps on actually performing a financial model as roughly as possible. Well, first, it could be a good idea to actually identify some companies that are comparables and key market data that will be fundamental for all your business. In this sense, when taking data from companies, you can perform a bottom-up financial model that, as we revised, is looking at the big picture from the pixels up. With this data from companies and actual sales and distribution patterns and everything that is important, but from actual data from companies, you can build up this bottom-up financial model. After that, it could be a good idea to actually develop a detailed top-down analysis from key market data and market dynamics, which again is looking at the picture from the top to down, from the big picture to the pixels. In this sense, when having both models already developed and both key data already gathered, it could be a good idea also to compare and rationalize both approaches. Because what is going to be interesting is that both approaches could be either really similar or really different. And if they are different, it could mean that your assumptions or rationales may be off or may not be as accurate as you would want it to be. Once you have compared and rationalized these two approaches to know that both are aligned, then it could be a good idea to actually feed some type of financial model to rationalize the data. In this sense, it is not really that relevant at the beginning of the value design process to actually perform a perfect financial model. It's only very, very important to actually have the good assumptions and that you have rationalized everything up. As you move on in your financial model strategy and also in the development of your company, you're going to see that your financial projections and statements are going to be more robust every day, and of course they are going to change through time. Once you have properly fit everything in a sound financial model, then you can build a final spreadsheet and projections so that you can actually show them to whoever it is needed. In this sense, these steps could be more or less the most essential steps on performing a financial model, and that's going to be essential for you to understand in order to realize that financial models are just a representation of what you want to be accomplished, and you just have to realize that the better you do this early on, the more likely it's going to happen. Alright, and with this we have concluded our module on financial models. If you want to know more about this topic, please go and revise our biodesign group book for more information on that. My name is Luis Soengsen, and thank you for watching.